Today, we are going deep into the Gamestop core. Third quarter 2025 financial results for the period ending November 1st, 2025. Our mission here is to really pull out the core insights from these documents to understand the huge shifts in not just their financial health, but, their entire business model.
Okay, let's unpack this. What happens when a legacy retailer seems to be shrinking? I mean, we're seeing a real sales contraction, but at the same time, they're reporting this massive surge in profitability and cash. It sounds like a paradox, and the numbers here tell an incredible story.
They absolutely do. This financial statement it's a remarkable case study. We're looking at a classic pivot where, management is clearly prioritizing margins and survival over just growing the top line. On the surface, yeah, you see declining net sales. That's usually a red flag.
Right. But then you dig in, and you find radically improved profitability and this almost unprecedented pile of cash. So as we go through this, we're going to keep two key comparisons in mind. First, Q3 of 2025 versus Q3 of 2024. And second, we have to talk about the difference between GAAP metrics, that's the official accounting, and the non-GAAP numbers that management uses to tell their story.
Let's start right there with section one, the profitability paradox. And we have to start with the top line because that's the contradiction, right? Net sales actually went down from $860.3 million in Q3 of 24 to $821.0 million in Q3 of 25. So they lost about $39 million in revenue year over year.
Which is significant. In any typical retail business, losing that much revenue would probably lead to more losses down the income statement.
But this is where it gets really interesting, because despite that sales decline, the operating performance, it didn't just get better, it flipped violently into the green. The company swung from an operating loss of $33.4 million last year to a striking operating income of $41.3 million this quarter.
That swing is nearly $75 million. That is the definition of a dramatic turnaround. And if you look at the straight-up GAAP figures, the official reported results, net income jumped from $17.4 million to $77.1 million.
Wow.
Which pushed their basic income per share from 4 cents all the way to 17 cents. That massive jump in profit is driven almost entirely by efficiency, not growth.
And we see that efficiency in two places, right? First is gross profit. They're just making more money on every single dollar they sell.
Correct. The gross profit percentage improved from 29.9% up to 33.3%. That means they're sourcing better, maybe marking things up more, or, and this is key, selling more profitable items. We'll definitely come back to that. But the primary driver, the real story here, is the SG&A reduction.
SG&A. And for you, the learner, that's selling, general, and administrative expenses. So your rent, utilities, salaries, all the overhead. They didn't just trim the fat here. It looks like they took a chainsaw to over $60 million of it.
Exactly. SG&A was slashed from $282 million down to $221.4 million. That level of cost control is the single most important factor. They basically engineered profitability by cutting operational costs faster than the revenue was shrinking.
But if they're cutting costs that hard while sales are still dropping, is that really a sustainable model? Or are they just, managing a decline very efficiently?
That is the essential question here. It suggests they're now running a much smaller, leaner, more focused business.
Oh.
We'll see evidence of that later with the geography. But yeah, this SG&A number is the financial proof of a radical downsizing. They're choosing profit margin over market share.
And this is where management often brings in those non-GAAP metrics to kind of explain their side of the story.
Correct. GAAP is the mandatory family photo. It includes all the one-time, non-recurring costs. Non-GAAP is like the Instagram filter. It smooths out those blemishes to show you what they see as the core health of the business. So they exclude things like asset impairments from store closures, stuff like that. And when they do that, their adjusted operating income jumps from a loss of about $24.6 million last year to an income of $52.1 million this quarter.
And the adjusted net income is even more dramatic.
Oh, it soars. It goes from $26.2 million last year to $139.3 million.
Okay, so that difference between the GAAP net income of $77 million and the adjusted number of almost $140 million, that's a huge gap. What's creating that?
A big chunk of it comes from a very technical accounting item. It's related to warrants issued to their debt holders, which creates a non-cash expense. It's complex, but the takeaway is clear. Management wants you to focus on that $139 million number. They're communicating that the core business, without all the one-time stuff, is actually very healthy now thanks to those SG&A cuts.
That sets us up perfectly for the next major shift. And this is where the story pivots from just efficiency to, real financial power, the balance sheet. The company is now a cash powerhouse.
The change in their liquidity is maybe the most defining part of this whole quarter.
I mean, the total of their cash equivalents and marketable securities, it nearly doubled year over year. At the end of Q3 2025, they had a staggering $8.8 billion. That's up from $4.6 billion a year ago. It's just an enormous cushion.
It is.
And on the operational side, you can also see they're running incredibly lean. Merchandise inventories are way down, from $830 million to about $575 million.
And that jump in cash, that extra $4.2 billion, is astonishing. The cash flow statement tells us exactly where it came from, almost all of it. We're talking $4.15 billion came from financing activities.
Right, so they didn't earn this cash from selling things, they raised it.
Precisely. They raised $4.2 billion from issuing convertible debt. For you, the learner, that means investors lent them money, but those investors have the option to convert that debt into company stock later.
A way to get a lot of cash now.
A massive amount. And that's why you see the other side of the coin on the balance sheet. Total liabilities, they ballooned. From $1.4 billion to $5.2 billion. That long-term debt line item went from almost nothing, $9.6 million, to over $4.1 billion.
So they essentially swapped their operational problems for a giant cash cushion, but they took on a lot of debt to get it.
That's the trade, yes.
So what does that mean strategically? A shrinking retailer sitting on $8.8 billion in cash.
It fundamentally changes who they are. They're now running two businesses at once, a shrinking but efficient retail operation and a growing capital management operation. That cash gives them immense flexibility, but it also raises huge questions about how they're going to use it.
And while they were piling up cash, they also started investing in some new asset classes.
Yes. The balance sheet now shows $519.4 million in digital assets, specifically Bitcoin.
So a $500 million bet on crypto.
And the documents really emphasize how volatile that is. For the year-to-date period, they actually had an unrealized gain of about $19 million on those assets. But in Q3 alone, the volatility cut the other way, and they reported an unrealized loss of $9.2 million. The cautionary statements are very clear. There's a huge risk in having that much money tied up in crypto.
It's an aggressive move. Okay, let's pivot back to the core retail business and look at what they are actually selling. Because the transformation isn't just financial, it's structural. Diving into the sales mix. The shift away from being a physical video game store is just undeniable. Look at the decline in software sales. I mean, that's their legacy business.
It is.
Year over year, software dropped from $271.8 million, which was almost 32% of their sales, down to just $197.5 million. That's only 24% of their sales this quarter.
That contraction just confirms the industry trend, you know? The move to digital distribution is still eroding the traditional retail model. The game disc is fading.
So if the game software business is shrinking, what's replacing it? What's the new focus?
It means the physical software store is giving way to the broader pop culture store. The breakout star in this whole schedule, the clearest signal of their future, is collectibles.
Right, so that's apparel, toys, trading cards, think Funko Pops and things like that.
Exactly. And collectible sales surged. They went from $171 million, or about 20% of sales last year, to an impressive $256.1 million. That's over 31% of total sales in Q3 2025.
And critically, for the first time in this quarter, collectibles revenue was significantly larger than software revenue.
That's the tipping point.
$256 million versus $197 million. That's a huge moment for their identity.
It is. They're no longer primarily a physical video game software company. Collectibles are now their second largest category after hardware. It's an aggressive shift to become a broader pop culture destination where general merchandise is more important than the actual game itself.
And that transformation links right back to the cost savings we talked about. SG&A was cut by $60 million. Let's look at how they did that, especially with their geographical footprint. The data shows a really clear move towards consolidation.
The sales breakdown by segment is incredibly revealing here.
Huh.
The U.S. market actually grew. Sales went from about $552 million to $617 million.
So the U.S. is the anchor.
It is. But look at the international side. Canada, sales dropped to zero from $46 million last year.
Just gone.
Gone. And European sales were nearly cut in half, from about $173 million down to $94 million.
And this isn't because those markets failed. This was a deliberate choice.
It's the strategy in action, exactly. The footnotes on restructuring costs explain it perfectly. The asset impairments they took, over $44 million for the year, are directly tied to plans to divest their entire operations in Canada and France.
So they decided it was better to take a one-time financial hit, cut ties with those markets, and just eliminate all the associated costs.
That is the efficiency play in a nutshell. They're getting rid of the overhead and the complexity of managing those non-profitable markets. The huge SG&A reduction comes directly from pulling back from those regions. They're focusing everything on the profitable core,
Yeah.
the US, and to a lesser extent, Australia.
And the ultimate metric that shows this all worked, cutting stores, cutting SG&A, running lean, is free cash flow.
Absolutely. Free cash flow is the acid test. It's the cash the business actually generates from its operations after paying for its own upkeep.
It's the money left over.
Exactly. And in the 39-week period, they completely turned this metric around. They went from a cash outflow of nearly $29 million last year to an impressive cash inflow of almost $410 million in 2025. That is undeniable proof that the strategy of cutting costs and shedding international stores paid off in pure internal cash generation.
So, to summarize the core narrative for you, the Q3 2025 results show a company that is prioritizing cash and profitability above everything else. They pulled off this radical turnaround through aggressive cost cutting, mainly in its SG&A, and by streamlining their footprint, getting out of countries like Canada and France, and they're fundamentally changing the DNA of what they sell. They're now reliant on high-margin collectibles, becoming a pop culture retailer instead of just a video game store. The whole story is one of radical transformation, even if the top-line revenue still looks a little soft.
That's the key takeaway. What's fascinating here is how they use debt and equity to build this enormous cash reserve. They've gone from a troubled retailer fighting for its life to an entity sitting on an unprecedented pile of capital, while also proving they can generate positive free cash flow from what's left of their operations.
It's an incredible shift.
It is. So the company now holds $8.8 billion in cash and marketable securities, plus over $500 million in digital assets. And given the significant debt they took on to get there, the crucial question for you, the learner, is this. How does a company with such a huge liquidity reserve, but a shrinking international footprint and a business shifting to pop culture items, how do they plan to deploy that $8.8 billion to achieve sustained, profitable growth? That massive cash pile is a tool for change, and how they use it or don't use it is going to define their next quarter and, really, their long-term survival.